Hi everyone, welcome back. I'm Nirasha Deseram and you're watching International Finance Part 2. So to start this section, first thing that we are going to look into is foreign investments. So under foreign investments, we are going to look into direct investments and portfolio investments and how this happened in Sri Lanka during the past few years, preferably during 2018. Okay. Yes. Foreign investments refers to capital flows from one country to another, granting the foreign investors extensive ownership stakes in domestic companies and assets. So simply, they are investing in domestic companies and assets. Okay, so this takes two forms: direct investments and portfolio investments, and we already have discussed what are the transactions that we identify under direct investments and what kind of transactions we identify under portfolio investments. And the main focus in this is the recent trends in foreign investments. And I have taken an extract from the central bank annual report, and none of these are my words. This is simply an extraction from the central bank annual report. So I'll read through this. This is the recent trends in foreign direct investments. The direct investment asset position as well as the direct investment liability position increased in 2018. The direct investment liability position increased to US dollars 12,757 million as at the end of 2018 compared to US dollars 10,755 million as at the end of 2017, with noteworthy inflows of FDI to BOI companies and the proceeds from the long lease of the Hambantota port during the year. There was a significant negative impact to the direct investment liability position due to valuation losses of publicly listed direct investment enterprises. Further, there was a notable debt to equity swap transactions of some major corporates, resulting in an increase in equity positions with an equal reduction in debt positions of these companies. Meanwhile, there were key mergers of some large corporates with significant direct investments resulting in consolidation of equity and debt positions of these companies as well. Despite the significant reduction in debt positions due to debt to equity swaps of some large DIEs, the liability position of debt instruments to DIEs increased overall, reflecting the increase in advances by direct investors. The top five sources in terms of direct investment liability stock position as at the end of 2018 were China, Netherlands, India, Singapore, and Malaysia. Meanwhile, the direct investment asset position, which represented direct investments abroad by Sri Lankan residents, stood at US dollars 1,433 million as at the end of 2018 compared to US dollars 1,375 million as at the end of 2017. Now we are going to look into the economic consequences of foreign direct investments. Now we are getting investments. These are foreign direct investments to your country. So obviously you are going to face favorable as well as unfavorable consequences both. There are going to be favorable results as well as unfavorable results. So firstly, if we go to the favorable results, favorable consequences, improving efficiency of resource allocation due to strengthening of international factor mobility. Then ability to fulfill resource gap due to inflow of an extra capital flow. So this resource gap we already discussed, and also this is a word that you come across first in your fourth lesson where you talk about this income approach, output approach, national accounting. Okay, ability to fulfill foreign exchange gap. Provides an answer to balance of payments deficit, non-increase of debt burden, ability to gain new technology to management, technology and management. So these are the favorable impacts Of course, this non-increase of debt burden, that is answering for balance of payment deficit and ability to gaining new knowledge and management. So these things you can always think and write. These are the plus points of foreign direct investments. These things you can think and write. You do not need to study these points. Then unfavorable. Outflow of huge amount of money as dividends and interest. Obviously, when they invest, you have to pay them back. Unfavorably affects over domestic economic activities. Loss of employment opportunities due to the use of capital-intensive production techniques. Overconsumption of natural resources, collapse of domestic industries, non-receiving of tax revenue to the government as expected. So these points are not much complex points. Those are all self-explanatory points. Okay. And now we are going to look into the recent trends in foreign portfolio investments. So as the same as the trends in foreign direct investments, none of my words are here. These are simply a total extraction of Central Bank Annual Report 2018. With significant reduction in market prices of outstanding governments, ISBs, government ISBs, outflow of foreign investments from the treasury bills and treasury bonds market, and a number of maturities of international debt securities of the banking sector, the outstanding portfolio investment liability position declined as at the end of 2018, despite the issuance of 2 ISBs by the government. Meanwhile, portfolio investment debt securities position recorded notable decline to US dollars 12,805 million by the end of 2018 compared to US dollars 14,087 million at the end of 2017. This was mainly due to a significant reduction in market prices of the currently outstanding ISBs as at the end December 2018, possibly as a result of investor sentiment in secondary markets due to political uncertainty in the latter part of 2018. Due to the deteriorated market sentiment, secondary market yields of the outstanding ISBs increased notably, also resulting in a significant decline in the market prices of the existing ISBs. Despite the increasing in outstanding liability position of ISBs issued by the government, with the issuance of new ISBs during the year, significant outflow of rupee-dominated government securities and SLDBs held by non-residents, as well as the reduction in market prices of existing ISBs, resulted in a moderation of the increase in outstanding total government debt securities held by non-residents as at the end of 2018. Meanwhile, the debt security liability position of deposit-taking corporations recorded a significant decline by the end of the year due to the settlement of international bonds issued by several banks amounting to US dollars 1,350 million. Okay, these points, of course, if these things are being tested in the examination, you will have to remember these points. So now that is the end of foreign investments. We discussed about portfolio investments and foreign direct investments. And now we are going to talk about the foreign exchange rate. So before going to foreign exchange rate, you need to know what is this foreign exchange market. What is the foreign exchange market is the first question. This is the global marketplace which determines the exchange rate for currencies around the world based on its demand and supply. This has been organized to facilitate international trade and financial transactions by providing foreign exchange. So this is the market where foreign currency is being transacted. Okay, foreign which facilitates international trade and financial transactions in foreign currencies. How does it operate? Forex market, that is a short form foreign exchange market. Forex market has been organized connecting traders around the world who engage in foreign exchange trade effectively, completing their transactions by deciding most beneficial price after inquiring information, related to purchasing and selling price of foreign currency from other traders, which most likely take place over the phone. Commercial banks perform a major role within the foreign exchange market through the publish of purchasing price and selling price of foreign exchange, where the gap between selling price and purchasing price shows the profit margin of a commercial bank. Hard currencies such as US dollar, sterling pound, euro, and Japanese yen are commonly exchanged at the foreign exchange market. So you know, right? Commercial banks only announce, commercial banks only say the exchange rates. They what you call? They display the exchange rates, the buying rate and the selling rate, and the difference is the profit that they earn. Then what are the parties that are engaging in a forex market or a foreign exchange market? So obviously you know now a commercial bank will be there. Then you have foreign exchange brokers. Then there will be business firms, central bank, general public, as well as the government involving in this forex market, dealing with foreign currencies, buying and selling of foreign currencies. Okay. Now we are looking into exchange rate. What is the exchange rate? Exchange rate is the rate at which one currency is exchanged with another currency. Okay, and you call this the nominal exchange rate, the rate at which one currency is being exchanged with another currency, that is generally the exchange rate, and you specially call this the nominal exchange rate. Okay, this can be presented in two ways. First one is the direct quotation. In the direct quotation, you express the value of the foreign currency in terms of the domestic currency, and this is what we normally use. You never tell the value of Sri Lankan rupee is this amount of US dollars. No, you tell $1 is this amount of US dollar, this amount of Sri Lankan rupees. So that is the general way we use. And there is indirect quotation as well, where you express the value of the domestic currency in terms of the foreign currency. Okay, that is you express the value of the rupee, which is the uncommon way, where you express the value of Sri Lankan rupee in terms of the US dollar. Now we are going to see how this determination is done. How you determine the value. First we'll see how the direct quotation happens. So you know what is direct quotation. You express the value of the foreign currency in terms of the domestic currency. And this is based on the demand and supply of a currency. So we'll read through. The exchange rate of a particular currency will be determined based on the demand and supply of the foreign currency in the forex market. Rupee value of the US dollar, this is an example. Rupee value of the US dollar is determined by the demand and supply of USD against LKR. I told you. Now we are going to see how the demand for US dollars happen, and the supply of US dollars happen. Demand for USD to settle payment transactions of balance of payment, such as import goods, travel to other countries, to repay debt, to pay interest for borrowings, and to pay transfers to foreign countries. There is an inverse relationship between rupee value of US dollars and the quantity of dollars demanded. That is, you exchange more rupees for dollars. Okay. Then supply of USD is the receipt transactions of the balance of payments, such as export of goods, receipt of primary income, and receipts of secondary income. That is, dollars are being exchanged for rupees. Okay, so in that case, there is a positive relationship between the rupees and the dollars, rupee value and the dollar supply. When demand for dollars and supply of dollars is balanced, that is where you determine the value of the rupee, and a diagram will be there in the presentation. Few slides, in few more slides. Then we are coming to indirect quotation. The exchange rate of particular currency will be determined based on the demand and supply of domestic currency within the country. This is indirect quotation. For example, the amount of US dollars that can be purchased with 1 rupee is determined on the demand and supply of Sri Lankan rupees. How this demand for rupees happen? To purchase goods and services from Sri Lanka, to travel within the country, to pay loans that has borrowed. There is a positive relationship between the dollar price of a rupee and demand for Sri Lankan rupees. And supply of rupees is goods and services imported from the other countries by purchasing dollars after supplying rupees. Therefore, there is a direct relationship between price of dollar, rupee in rupees and rupees supply. I'm sorry, supply of rupees, this has an indirect relationship. Okay, this has a direct relationship. Demand for rupees has a direct relationship. Supply of rupees has an indirect relationship. At foreign exchange market, demand for rupees and supply of rupees determine the price of 1 rupee in dollars. Okay, so this also, you will see the diagram in few slides. Now we are going to look into the exchange rate. So now you know how this exchange rate is being determined and where this exchange rate, where this foreign currency transactions are being happening. So we are going to study about the types of exchange rates. So there are 3 types of exchange rates: fixed exchange rate, free floating exchange rate, and the managed floating exchange rate. And we are going to study about each of these exchange rates. Firstly, we'll see about the fixed exchange rate system. A fixed, or you call that a pegged exchange rate. There what happens is the exchange rate is set and maintained by the central bank or the financial authority of the country as the foreign exchange rate. It is being set and no changes happens. And generally the gold standard was used in earlier days to use, as the basis for this fixed exchange rate system. The gold standard, this is a small note for you to understand what this gold standard is. This refers to the issue of currency based on gold reserve system. When USA deposited 1 ounce of gold at Federal Reserve Bank, it issued $35 US. Try to understand this scenario. When USA deposits 1 ounce of gold at the Federal Reserve Bank, they give $35 US. And when 1 ounce of gold is deposited in the Central Bank of England, they got 12.50 sterling pounds. That means 12.50 sterling pounds is equal to $35 US, which means 1 sterling pound will be equal to $2.80 US. Okay? So that is how this gold standard worked. That is about the fixed exchange rate system. And then we are coming to free floating exchange rate system. A free floating exchange rate is the rate between 2 currencies which is purely being determined by the demand and supply of a currency in the forex market. That means the exchange rate, this is what happens in the previous scenario which I explained to you in the direct quotation, indirect quotation, where the exchange rate was determined by the demand and supply forces. So this is the exchange rate, that is the free floating exchange rate or the flexible exchange rate is the exchange rate which is being determined by the demand and supply of a currency in the forex market. Okay. Demand for currency is created through exports and other international transactions which require people to exchange foreign currency to local currency. This we have already discussed, how the demand and supply for a currency happens. Supply of currency is created through imports and other international transactions which require people to exchange domestic currency with foreign currency. Therefore, free float exchange rate system mainly depends on the country's international transactions. Okay. And we have managed floating exchange rate system, which is what Sri Lanka has at present. This is a combination of both fixed exchange rate and free floating exchange rate. What happens in this scenario is you allow the exchange rate to fluctuate within a certain limit. You have the upper limit and the lower limit, and within that limit, exchange rate will fluctuate. That is okay. But if the exchange rate goes beyond those limits, then the monetary authority, preferably in Sri Lanka Central Bank will intervene and control the exchange rate. So a managed floating exchange rate is a rate system is simply a combination of fixed and free floating exchange rate system where the central bank permits the free float but intervenes on a regular basis to maintain the rate within the agreed limits. This is mainly done through buying and selling of both domestic and foreign currencies. You can't just intervene and say this is the exchange rate. No, you have to follow certain strategy, and the strategies you buy and sell foreign and domestic currencies to manage the exchange rate. Now you have the advantages of fixed exchange rate. Now in this video we'll be looking at advantages of fixed exchange rate system and the advantages of floating exchange rate system, and you need to know what I have given to you in brackets as well. Advantages of fixed exchange rate system are the disadvantages of a flexible or the floating exchange rate system. Okay, then the advantages of the free floating exchange rate system are the disadvantages of the fixed exchange rate system. Okay, understand that clearly. So first we'll go through the advantages of the fixed exchange rate system. Promotes international trade and investment. You will understand when I'm reading through. Fixed exchange rate system creates stability. Why? Exchange rate is fixed, no fluctuations. When the value of the exchange rate is fixed, it doesn't create fluctuations in the international trade and increase the trust of international investors on the value of the currency. So your exchange rate is fixed and they know what their return is. It's not going to vary. Okay. That is, international investors, they know what is the return that you're going to get because the exchange rate is fixed. Provides macroeconomic discipline. Fixed exchange rate system avoids currency appreciations and depreciations and thus doesn't make any impacts on any macroeconomic variables. Promotes international cooperation. Fixed exchange rate system is identified as an indirect agreement between countries to not to influence other countries by changing exchange rate. So exchange rate is fixed and this is an agreement between countries. If one country changes the exchange rate, then this cannot work. Okay? Then removal of speculation. Since the exchange rate is fixed, investors do not practice speculations. Advantages of the floating exchange rate system is what we are going to look into now. First one is it ensures BOP stability. Exchange rate fluctuations provides an automatic adjustment for countries with a large BOP deficit under floating exchange rate system. Then flexibility determining interest rate. Floating exchange rate system gives the monetary authorities the flexibility in determining the interest rates. Promotes economic stability. Under free floating exchange rate system, any changes in the exchange rate will affect imports and exports and will adjust the market without any interference of the central bank because the exchange rate automatically gets adjusted. Monetary autonomy. Under free floating, central bank is free to implement its monetary policy without considering the exchange rate because you really don't have to control it and you really don't have any control over it because you're following a floating exchange rate system or a free floating exchange rate system. Okay, now we are going to see one point which I forgot to mention is advantages of free floating is again the disadvantages of fixed exchange rate system. Okay, now we are coming to effective exchange rate. What is the effective exchange rate? We'll see. The effective exchange rate measures the value of the domestic currency against the weighted value of a basket of foreign currencies, where the weights reflect the foreign country's share in the domestic country's trade. You might not understand the definition, but when you do this sum, you will obviously understand what this is. Okay. Again, if we read through, the effective exchange rate measures the value of the domestic currency. It measures the value of the domestic currency against a weighted value of basket of foreign currencies. This is a weighted value of basket of foreign currencies, and this weight is determined based on the foreign countries' share in the domestic country's trade. Okay. So this we calculate in two ways. First one is a nominal effective exchange rate and second one is the real effective exchange rate. Okay. Nominal effective exchange rate is an unadjusted weighted average rate at which one country's currency exchanges for a basket of multiple foreign currencies. This is an unadjusted value. This is not adjusted for inflation. You see the exchange rates are given in two countries and the weightage is given. USD is 75% and Euro is 25%. So the value how you are calculating nominal effective exchange rate, you get the summation of this divided by the summation of the weightages. And that is your nominal effective exchange rate. Okay, what is this? R times W, that is the exchange rate into the weightage. So here in this case, it is 115 to 75 and here it is 200 into 25. And you get the summation of those two and you get the total of the weightages and you get the nominal effective exchange rate. Now do you see? You measure the value of the domestic currency against the weighted value of basket of currencies. Weightage depends on the country's share in the domestic country's trade. Okay. Now, what is this real effective? When you hear the word real, you know it is always inflation adjusted. The real effective exchange rate is the weighted average of a country's currency in relation to an index or basket of other major countries. It's a weighted average. Okay, this is inflation adjusted. So now here you know the nominal effective exchange rate. And if you are given the average change of inflation among the countries is -2, you have to deduct 2 from this. If this was +2, you have to add 2 for this. That is how you get the real effective exchange rate. And now one other concept, which is purchasing power parity exchange rate. According to purchasing power parity exchange rate, in a competitive market, similar goods in different countries should be sold for the same price when the prices are stated in the same currency. That is the same, the goods basket which you buy in Sri Lanka for $1,000, 1,000 rupees, you have to be able to buy that same basket in India, maybe in China for 1,000 rupees. If you are expressing this in terms of purchasing power parity exchange rate. You will understand this better through this example. It's given to you. Price of the selected basket of goods in Sri Lanka is 500 and in USA, the same basket. I'm sorry, here yes, in both the cases, the basket is spelled wrong. The basket in Sri Lanka is 500 rupees and in USA, it's US dollars 25. Then, what is the price of 1 USD? That is 500 divided by 25, which is 20. So, this is what you call the purchasing power parity exchange rate. If nominal exchange rate and purchasing power parity exchange rate is equal between two countries, that means price of goods of the both countries are equal to each other. Do you understand? That is the if you have a nominal exchange rate. That is the general exchange rate that we use, and we have purchasing power parity exchange rate as well. If these two are equal, then the goods basket that you buy for 1,000 rupees in Sri Lanka, you will be able to buy the same goods basket in USA as well. Okay, that is what is being said in that. Now, another two more important concepts: depreciation and devaluation. What is depreciation? This happens in a flexible exchange rate or a free floating exchange rate, where the exchange rate is solely depending on the demand and supply forces. This is the fall in the value of currency against another due to market forces, which generally takes place in a free floating exchange rate system. That is what you call depreciation. And there's another term called devaluation, that is the monetary authority intervene and deliberately reduce the exchange rate. That is what you call devaluation. Okay, deliberate movement of the exchange rate. That is deliberately you are reducing the value of your currency. Okay, economic effects of exchange rate devaluation are given: increase in the domestic price of imports. You know, the value of your currency is reducing, that the imports are being expensive now. Import expenditure is greater than before. Domestic inflation can be caused. Increase in foreign debt service payment. Balance of service account of balance of payment will be favorable due to increase in the earnings from tourism. Secondary income account being favorable due to increase in worker remittances, including Middle East employee remittances. Export earnings will be increasing because your goods are cheaper now. your goods are competitive. Okay, so there are positives and negatives both. And now, what are the objectives? Why would you devaluate your currency, and what are the conditions that has to be there to devalue your currency? Objectives. First one is to minimize the long-term deficit on balance of payment. What is deficit? Your imports are greater than your exports. When your currency is being depreciated, automatically your imports will go down in some time because it's expensive now. Discouraging of import demand. Then the encourage of export supply, your goods are cheaper. Encourage of worker remittances because they can buy more goods now. And improving of foreign direct investments. Then conditions. There are 5 conditions for an effective devaluation. First one is foreign demand price for export should be elastic. Domestic demand price for import should be elastic. Some value of price elasticity of demand for exports and imports being greater than 1. Domestic supply related to exports being elastic, and domestic price levels limit remains constant. These 5 factors of these 5 conditions, of course, you will have to remember. Okay. So we discussed about depreciation and devaluation, and now we are going to discuss about appreciation and revaluation. What is appreciation? The opposite of depreciation. There the value of the currency increases due to market forces, and again it happens in the free float. Revaluation is the central bank deliberately intervene and increase the value of the currency, and this happens normally in a fixed exchange rate system. Central bank intervention. Then economic effects, decrease in the domestic price of imports, so these are the opposites of a devaluation. Okay, decrease in the domestic price of imports, the value of foreign debt in terms of domestic currency will go down. Then increase in the cost of repaying debt, increase in import expenditure due to increase in demand for imports with an apparent decrease in domestic price of imports, negatively affecting the balance of payment. Discouraging of exports. Why? Because your exports are expensive now, and unfavorable for foreign employees as domestic value of foreign earnings are going down. Okay, and this is the diagram which I told you, where the direct method and indirect method. Here the demand and supply of dollars. This is the demand and supply of rupees. This is what I wanted you to see. Okay, so this is the direct method where you express the value of dollar in terms of rupees, and here you express the value of a rupee in terms of dollars. Okay, and these are the factors affecting exchange rate given to you: international trade, capital mobility, price fluctuations, speculation, economic strength, government policies, share market activities, and political situations. These affect the exchange rate of a country. Okay, and finally we are coming to multilateral financial institutions, and in this under this chapter, this section, we are going to look into World Bank and IMF. These two we have discussed earlier as well, but this is going to include detailed notes on those two. Okay, so I'll just read through that because you have to study it. There is nothing to explain. Multilateral financial institutions refers to financial institutions formed by gathering of many countries of the world with an objective of improving world trade by strengthening international monetary cooperation and to develop systematic foreign exchange rate system. Okay, so it is a collaboration of countries. So we are going to look into World Bank and IMF. World Bank was established in 1st of March 1947 with 42 member countries, including United States of America, United Kingdom, following the Bretton Woods Summit held at Bretton Woods, USA in July 1944 with an objective of reconstructing European countries destroyed by the Second World War. World Bank, which started its functioning in 1946, was consist of 38 member countries initially. At present, there are 186 developing and developed countries as members of it. World Bank, you have two main institutions. So these things were not there in the first, the previous lesson. That's why I included everything. International Bank for Reconstruction and Development, and you have International Development Association. And in this table, you will see objectives and functions of the World Bank in detail. Okay, World Bank objectives. Yeah, again, if you can remember up to 4, it will be enough. Speed up economic development of member countries by providing investment facilities for production activities, establishing opportunities and provide facilities to encourage foreign private investments where member countries are unable to gain foreign capital under lightened conditions, providing of long-term loans for the productive production activities of member countries with the use of its own funds and the funds gained through other sources except private investments, establish balanced growth of international trade through the improvement of production resources of member countries and by encouraging international investments, and finally reducing of world poverty. Now, if you're going to write only this for a 1 mark, you will have to elaborate this a bit, because of 4 words you can't expect 1 mark. Okay, so if you're remembering these 4 points, you just remember in brief, and when you go to the examination, you can elaborate those and write. Okay, functions of World Bank: providing of financial and technical aids to member countries, providing of loans to member countries under concessionary conditions, providing of assistance to member countries to absorb foreign investments, providing of expertise knowledge to plan and regulate necessary projects to speed up development of member countries, act to improve living standards of people to establish sustainable development, and to strengthen cooperation between public and private sector, provide necessary assistance to its member countries to reach the path of globalization, provide aids to its member countries to overcome unfavorable situations faced at the world market, and finally provides assistance to build favorable relations among world population, provide assistance to its member countries to implement new economic policies. Now, yes, if you can remember 4 objectives and 4 functions, that would be fine. And now we are going to look into IMF, International Monetary Fund. IMF was established in 27th December 1945 with an intention of improving international monetary cooperation and to improve effectiveness of foreign exchange rate system by establishing stable foreign exchange rate. Also, it was established to improve economic growth and employment level, and also to provide temporary financial aids to facilitate balance of payment adjustments. There were 29 member countries initially, and today there are 186 member countries. Again, you have the objectives and functions of IMF. If you can remember 4, that would be very much enough. Objectives of IMF: to promote international monetary cooperation through a permanent institution which provides the machinery for conciliation and collaboration of international monetary problems, to facilitate the expansion and balanced growth of international trade and to contribute thereby to the promotion and maintenance of high levels of employment and real income, and to the development of productive resources of all members as primary objective of economic policy, to promote exchange stability, to maintain orderly exchange arrangements among members, and to avoid competitive exchange depreciation, to assist in the establishment of a multilateral system of payments in respect of current transactions between members, and in the elimination of foreign exchange restrictions which hamper the growth of the world, to give confidence to members by making the general resources of the fund temporarily available to them under adequate safeguards, thus providing them with the opportunity to correct maladjustments in their balances of payments, without resorting to measures destructive of national or international prosperity. In accordance with the above, to shorten the duration and lessen the degree of disequilibrium in the international balance of payments of members. Then you have again the functions of IMF: providing advisors when national economies and world economies face various economic and monetary matters, and thereby to help stabilize the economies. Provide advisors to maintain laws and regulations needed to establish quality of the banking and monetary activities. Providing temporary credit facilities to member countries to overcome sudden financial crisis situations. providing financial facilities to overcome long-term economic problems and make necessary steps to provide solutions for economic problems through economic reforms, providing technical assistance to member countries and trade government and central bank officials, and finally, making of standards related to fiscal, foreign financial, and national accounts between countries, and distribute mutual understanding and education among member countries by publishing information accordingly. I know this is a bit of a hard work in this lesson. I don't think any of these other chapters, other subheadings that we discussed was that much difficult, because I know memorizing these points, all the other things which we discussed, you can understand it. But these points, of course, you will have to memorize it. And I want to tell you one point I should have told at the beginning of this. This is not going to be a note for you, but you can use this as a short note. You can study the notes that you have, and you can use this as a short note. The whole lesson, the whole presentation, the slides which have been shared with you, as a short note for you to revise this lesson. Okay? So yes, so that is the end of this lesson, and thank you so much.